lot of the buyers that we have are very key entrepreneurs, very successful business people who wouldn't be in the business if they didn't know that sometimes you got to roll the dice and go with your gut.
Without further ado, going to tonight's incredible guest, Harry Dublinsky, principal at Wilson Park Group, and joined by a guest, Jay Cardwell, COO at the CFO Squad. First, about Harry. As a business strategist, financial leader, and CPA, Harry Dublinsky has a proven track record of guiding high net worth individuals. Over the past 3 decades, Harry has worked in both private industry and he has worked for the Big Four, as they're known, the Big Four national accounting firms. Jay Cardwell, COO at the CFO Squad, has worked with and assisted numerous investment bankers and clients in M&A transactions. Of course, that's merger and acquisition, from both the buyer and the seller perspective. So on tonight's show, we're going to talk about financial assessment tools that are critical to any business deal. And we're even going to talk about, for those that are exploring out there, how to take your company public. Harry Dublinsky, Jay Cardwell, welcome to Mind Your Business.
Great to meet you.
Thank you. Yes, I'm going to open with Harry. Harry, it's the first time you've been on the show here. Jay, we've had the honor and pleasure of being with Jay in the past, and we're looking forward to getting the 2022 look, and especially with the how volatile the market has been now, and we're recording here in May 2022. But Harry, please tell us about your storied career, your background. Not that you're an old guy, but you have a lot of experience.
Right. Thank you, Yitzchok. First, I want to thank you so much for that warm welcome. I've been a big fan of Mind Your Business for many years.
Thank you.
I salute, admire your high-octane energy. It's tremendous.
Thank you.
And I'm glad to be here with my good colleague, Jay Cardwell, the financial expert, CPA. Our claim to fame is that we both had stints together at Arthur Andersen, which was then the largest accounting advisory firm in the world.
Yeah. So tell us about, today you founded a number of years ago, Wilson Park Group. Talk about what led up to that and what type of services businesses turn to you and individuals turn to you.
Right. I formed the Wilson Park Group during the pandemic with the belief that, things have fundamentally changed for my clients, for my colleagues, and for my own business interests. I say with the false sense of certainty out the window, the need evolved to be more nimble, dynamic, opportunistic, to best service my clients, my relationships, and my own business interests across the spectrum. As a seasoned, battle-tested CPA, my services include the following on the financial and strategic consulting side. I provide outsourced CFO services to private businesses, startup companies looking to expand. I work with many entrepreneurs, startup companies as a consultant or even as an advisory board member. And with investors, I serve investors in the following way, both institutional, private, whether they're high net worth individuals, whether they're family offices, and I help them basically guide through the myriad of investment opportunities that literally are coming their way on a daily basis there. This assessment is done primarily by performing financial due diligence, which is a topic that we will basically be digging deep into during this session.
Now, Harry, I'm sorry. Please finish up.
That's to finish the spectrum of services that I provide. I'm also a registered securities representative where I raise equity for private transactions via my affiliation with a broker-dealer, and I also have a real estate license.
Now, Harry, as an auditor for many years, could you walk us through that? What are the benefits, the outcomes, why a company should go through and when they need to go through an audit? And we're not talking about an IRS audit here. We're talking about, please explain.
Just to define what an audit is, an audit is basically an independent review of a company's financial statements by a qualified CPA, and I trust a quality CPA firm. So the CPA comes in, performs various tests to ascertain whether the financial statements are free of material misstatements. What are financial statements? It's your balance sheet, which includes your assets, liabilities, and the resulting owner's equity. It's your P&L, as we call your profit and loss statement, your cash flow statements, which basically gives a depiction of how the company has done over a certain period of time. And as an auditor, there are various standards that need to be done in order to provide this service, especially after various financial scandals over the last few decades, starting with Enron, starting with Bernie Madoff and all that. But the trick to the problem is, or the crux of the problem is the fact that audits are costly. They're prohibitive. So it's hard for a startup company, which is stretched for cash, to go ahead and allot money to this process there. And moreover, a lot of the companies are pre-revenue, and there's not much really there to audit except perhaps maybe how much cash they have in the bank. So that's why when we're talking about due diligence, that's an alternative means to go ahead and kick the tires and to see, to assess the viability of the investment proposition.
Now, Harry, if I could turn to you, one of the financial assessment tools and terms is unit economics. Can you please explain that?
Right. So unit economics to me is also part of the vision. Like we hear a lot of pitches. Yitzchok, you probably hear as a prominent businessman, and you hear these pitches, and many of us watch Shark Tank. So there's pitches galore. And, a lot of the entrepreneur sponsors that come in with these, nice fancy pitch decks, these 5-year, 10-year projections with numbers all over the board there. So how do you go ahead and make an assessment? Obviously, you're looking to the strength of management. Can they carry out their vision? Do they have that fire in the belly to go ahead and actualize the projections that they're putting forth? So one of the ways that I do it is call it the unit economics or back of the envelope. If you have a widget X, that you want to bring to the market, and meanwhile there's a competitive widget Y there, what are the unit economics? What makes your product stand out from others there? And I think the ability to visualize the deal, to visualize the proposition, helps an investor that's looking at a deal make an assessment. Does this make sense, instinctively? And then what happens is that once you understand the unit economics, then you could go about extrapolating this towards whatever the projections show in the aggregate over many years, 5 years, what have you, there to see, does it make sense? Is the company well capitalized? Will it have the capital go ahead and actualize their vision there? And I think this week, the Uber CEO came out, used that term unit economics as well, because they have to go make cuts on their costs, administrative costs, and what have you there. As he said that, there's issues with the unit economics. So that's why I think it's a key. I think it's a catch-all for trying to take a deal and taking it from 30,000 feet in the sky to putting it on level ground. So if you were out there going ahead, buying the service, buying the product, does it make sense? Would you be a consumer for it?
Tonight, we're talking about really I think it's okay to say the forensics of the financial side of business. And we're speaking with Harry Dublinsky, who is the principal at Wilson Park Group. And we're joined also with Jay Cardwell, COO at CFO Squad. Harry, apparently you're good buddies. You work alongside Jay. Perhaps you could just introduce our great guest, and then we'll pick up the questions.
Pleasure to have Jay with us. Thank you for joining. We thought that as we go through the due diligence, we could cover both sides of the deal, the seller's side and the buyer's side, to simulate how that would go about in a heated negotiation and due diligence process. You mentioned Jay is a very talented CPA. We worked, the same firms, and recently we've been working on a SPAC deal together. So it's a great pleasure to welcome Jay to the program, and thank you for joining me.
Yes, Jay.
Hi, it's good to be back on Mind Your Business.
Yes, thank you. So perhaps, again, it's been, I I don't know if it's a year or 2 years since you've been on. Sure. Perhaps you could take us through in a minute or two your background.
Sure. Like Harry, I started my career with Arthur Andersen. I was in their St. Louis office in both audit and tax and working with some sort of global 500 companies. And then I came to New York. And for about 30 years, I worked in various C-level positions as a CEO, as a COO, as well as a CFO for a variety of companies, both public and private, mainly in the media and entertainment industry. So I was dealing with film and television and Broadway and various other companies in that area. But then since about 2015, I've been working with the CFO Squad and been working with clients, concentrating on their financial reporting for both publicly traded clients and their SEC filings, as well as clients that want to go public and are exploring those going public efforts. So I've been on both sides of the fence and sort of understand sort of the pressures of those sort of executive and business owners. But CFO Squad is sort of that, not a sort of a typical accounting firm. We don't do the audits. We actually help companies get ready for their audits because auditors have to be independent. And so we help them prepare those financial statements, providing, a variety of services between, the financial reporting, as I said, M&A transactions, these pre-audit services, as well as tax and sort of other advisory services.
So now, in this part of tonight's program, I want to focus in on financial due diligence. Now, from Harry's perspective, we're going to talk about buyer's due diligence, and then I'm going to come back to Jay about the seller's due diligence. So, Harry, perhaps you could open up. What is, in layman's terms, what is financial due diligence, and why is it so critical?
Let me first define the term. What is due diligence? So, due diligence is the investigation or exercise of care taken by a reasonable business or individual before a deal is consummated, before you enter a contract or a deal. So, for example, Yitzchok, let's say one of your buddies comes with this great real estate deal and they're looking you to write a check. You might like the guy, you might like the sponsor, but you're a smart business person and you're going to say, hey, I have to kick the tires. I have to look under the hood. So there's different types of due diligence that is performed. Tonight, we're focused on the financial side, but there's legal due diligence, environmental due diligence, operational due diligence. So some people say, what do I need to go ahead and kick the tires? I know the sponsor, I know the family, I went to high school together. And, there's a saying, penny wise, pound foolish. And moreover, the former President Reagan said, trust but verify. So I think that's the process that's being performed when you do due diligence. And also, I've been involved in very complex due diligences where the team performing these procedures are used strategically in the negotiation process because they're still negotiating price and all that. So if you're out there actively and skillfully kicking the tires and doing these procedures, you come up with certain things. I had one property, about a $50 million acquisition up in New York State of a multifamily complex. We found that there was radon contamination in the property by digging through fixed asset records because we saw the remediation costs that were capitalized on the books. We walked through a student housing complex down in Texas, and what supposedly was vacant units. We saw that, I guess, the superintendent was putting students there, girlfriends were there, animals were there. So that's part of the process and the negotiation that's being processed. But it's heated. The question on due diligence, and I guess when Jay puts on his seller's card, is who has leverage in the deal? Where are we in the cycle in the marketplace? Today we're way different than we recently were, especially in real estate with multifamily and all that, where there was perhaps little or any due diligence period allowed in the contracts. But now, with the recession and the fears out there, I think the pendulum is starting to turn the other way.
So before we get to Jay, just let's hold on to the buyer side of it, the buyer's due diligence. You did explain it in a general way, but perhaps why that's so key, and then we turn to the seller side.
One, it's on the buyer side is because you want to basically see that the cash correlates with the projection and the vision there.
Yeah.
And the way to do that, especially I mentioned earlier that a lot of these startups or smaller companies don't go through the audit process there. So what type of verifiable information do you have to work with? So a skilled auditor who's performing now the due diligence knows how to go in and do certain tests to the financial records. To me, cash is king. So a lot of the assertions or the historical performance that they're presenting, I'm going to try and take back to some degree, back to the cash, the bank statements and what have you there. I want to look at rent rolls or with companies. I want to make sure that the numbers make sense, that you could corroborate them. And then moreover, I want to sit in the conference room with the CEO of the company or the sponsor, and then I'm going to start asking them some heavy press questions, like tell me about, do you have any off balance sheet liabilities, any legal contingents, loss contingencies out there, any lawsuits and what have you. And I'm looking for that expression. What has become common, especially during the pandemic, people working remotely, was the virtual war room or data room, where a seller is dumping in information after a minute. And what happens is used strategically because they know a firm has to go ahead and inventory the documents. So I throw some more documents in, I throw them off target a bit. So there's a lot of give and take there. But I think it's still important the old-fashioned way. You go, you sit, you ask the sponsor, or you ask the seller the pointed questions. Do you know your numbers? And when they start telling you, go speak to my lawyer or someone else, it means that they're not really living their deal. So I get concerned in that regard.
Now, before I turn to Jay, one line that you had mentioned that jumps out, Harry, is from President Reagan: trust but verify. And it's such a great point. And I use this as an intro now as I turn to Jay Cardwell, who's the COO at CFO Squad. The buyer, right? The buyer out there has to do their homework. Yes, there has to be a good feeling. There's something in the kishkis that, I could trust this guy. But at the end of the day, there's got to be due diligence. Now, from the seller's perspective, they just want to, I don't know, say unload or whatever it is. They want to move on from that and they want to sell it. So what is seller's due diligence?
Well, I think similarly, the seller wants to know as much as possible about the buyer. Some deals, or I should say all deals don't come with just a cash buyout. I mean, some people say, hey, I want to sell, and hey, you get all the cash and you're out the door and you're gone, right? But in many times, you're actually getting paid with somebody else's stock, or maybe a combination, maybe stock and debt. And now someone might be owning your company, controlling your company, or you might even be a partner, or it may be a lender, in this deal that's just coming with capital to support your organization. And you want to make sure that they're capable of holding up their end of the deal. You don't want to receive, here's $100,000 or here's $1 million in cash, and I'm going to give you $10 million of stock because your company is worth, $10 million or $11 million or more. But that stock is worthless the next day. So you need to do your homework, and you need to know from a seller's point of view, are they going to be my partner? Am I now going to be working for them? Or are we doing it together? And have they done similar deals? Have they completed those deals? What's their capacity? I've seen many bankers come to the table and says, I've done many deals, but they represent a fund that has already fully pledged all of their dollars, and they actually can't close a deal. So all of a sudden you waste an enormous amount of time when that person can't actually reach a final deal. Those are, sometimes that sounds absurd, but in many cases that has occurred. Or they run out of money in the middle of the due diligence period, and you've got to know, are you the last person in the door or the first person in the door type thing, And some of them, they may be looking for other deals, so you got to know, are you the only person at the table that they're shopping to buy, or are you just one of many, and you got to know you're competing out there for their money, for their attention as well.
First, I turn to Harry. By the way, we're very proud of the website, Wilson Park Group. Anything else you wish to add there, Harry, before I turn to Jay?
Great. I've had the great pleasure of knowing Yitzchok for a number of years, and I've had the privilege of having them design my firm's website. And I like the hands-on approach, great team, creative, innovative, and moreover, hands-on. They move quickly, they get it done.
Thank you. Thank you.
It's a great, they have fire in the belly in bottom line marketing.
Thank you.
Bravo.
Thank you.
Yitzchok and his producers is wonderful.
Thank you. Jay, just how could people find out more about CFO Squad?
First, you can go to our website at www.cfosquad.com.
Mind Your Business with Yitzchok Saftlas right here on 710 WOR. A special a reminder or shout out or just letting everyone know. On our YouTube channel, you can access most of the excellent interviews that we've had on this program. When you subscribe on YouTube we're at 710 WOR Mind Your Business. Again, on YouTube, 710 WOR Mind Your Business. You are automatically notified every single time a show gets uploaded. And tonight's show will get uploaded. Tonight we're speaking with Harry Dublinsky, principal at Wilson Park Group, and Jay Cardwell, COO at the CFO Squad. And we're talking about a lot of key critical subjects regarding the financial well-being of a company. Before the break, we talked about due diligence, and Harry took it from the perspective of the buyer's due diligence, and Jay addressed the seller's due diligence. So now I turn to Harry and Jay to talk about how this could make or break a deal going through the process. And before the break, we discussed how critical it is to look at it from each side. But now, talk about real life situation. I'm not asking to share anything that's confidential, but maybe even some real examples. We're going through a deal and boom, something was exposed that wasn't talked about initially. So first I turn to Harry and then to Jay.
Right. I think first to set the proper context is, where are you in the transaction? My belief, you have to ascertain who has leverage in the deal, the seller or the buyer. And moreover, it gets down to the underlying target, asset acquisition, all that, and what the vision the buyer has for it. Sometimes the numbers aren't as relevant because the buyer has different plans. They want to reposition an asset, or they want to have ultimate goals that differ from the way the business has been carried on. So it's not as critical. But for those type of deals that we've been seeing, especially in real estate, you have to say, am I looking for the long term? And I'm saying that maybe I'm ready to pay a premium now, and maybe I don't have enough time to do a rigorous due diligence process. That's where the gut feeling kicks in. And that's why a lot of the buyers that we have are very key entrepreneurs, very successful business people who wouldn't be in the business if they didn't know it. Sometimes you got to roll the dice and go with your gut.
Yeah, so now I turn to Jay on that.
I always try to say that the deal has to be good for both sides, but I think it is critical to understand what is the motivating factor on both sides. Why am I selling? Why is someone buying? And it's also being ready for the deal. And we'll get into more due diligence, but if you're going to enter in a deal, know that you have everything ready, or as much as possible. Maybe you're just selling a customer's list, or maybe they want the entire business, or maybe they just want the product that you own or your market share for their own distribution channel. So understand what they're expecting, and also in some cases, make sure that the people around you are on board, right? Things can break down when I think employees, or maybe you have partners or shareholders that you have to deal with, that they're not ready for the deal, and that they need to be on board before you enter that room.
And Jay, I remember you shared this in a previous show. Your belief and feeling, and you've seen this in real world, that in general the deal should be good for both sides.
Yeah, absolutely.
Yeah. Now,
absolutely.
And like you and Harry shared, the definition of a good deal varies. Sometimes it's the cash, it's the property, it's the branding value, it's the product. Perhaps you could even share some other maybe examples, either of you, on what type of benefits are in it for someone going ahead with a transaction?
Well, I think in some cases, it's what are when I say what are the expectations of both sides, I mean, a lot of times there are risks involved, and therefore a buyer sort of says, okay, you believe your company's worth X, but prove it. And maybe you have to come up with a price and you have to earn it out. Well, what is the bonuses if you exceed your targets of those acquisition deals? So make it palatable on both sides so that you can enter the deal and close the deal. But if you do better than expected, or on either side, what are the rewards that one might expect, and how are you going to get paid in those rewards? Cash, stock, other elements.
Good. Harry, just before we move on, perhaps you could share how Wilson Park Group, by going through these steps, have yielded great revenue for companies, some of your clients.
By being engaged, because if the seller understands that the buyers are serious, they engaged, experienced professionals who have a reputation for going in and doing the diligence professionally. We're not ambulance chasers, of course. We go in with a team, we go ahead, we know what to look for, what are the key tell signs as to the viability of the business. The numbers make sense, and if we start drilling away, so to speak, and we see that there's no basis, like if you look at you try to benchmark some of the numbers and the projections and all that, if there's no basis, there's no validity to them, then it throws the whole deal into question, because deals based ultimately at the end of the day, you're looking for cash flows, or you're trying to project cash flows, will come in with stress test the numbers and all that. But also part of the process of due diligence, and one of the questions I think we'll be further discussing, is the notion of creating that working capital model. And I think due diligence gives you a good head start towards that process, because Yitzchok, you write a check, you buy a company, the company closes, there you are day one in the cockpit, so to speak. You have a business to run, you have employees and all that. Where's the cash? You have to basically make an assessment. You have to understand going into the deal, are there any redundancies vis-a-vis overhead and all that? And if you're already in the business, how do I start to create perhaps an economy of scale? And that should go into your projections, into your investment decision process. The projection, the working capital model, cash, doing the stress tests there, and also making an independent determination that if need be, when you have the financial wherewithal, the cash reserves in order to take the business out of the gate and to keep operations afloat.
Harry, can you please explain the difference between a cash flow deal and a big exit appreciation deal?
I think that's a good one that I'd like to discuss, perhaps back to my real estate roots. Real estate, we look at pretty much four risk profiles. One are what they call the core deals, which are the low risk. Maybe they return 7 to 10%. There's core plus, which are low to moderate risk. So you have a building, maybe you need to go ahead and do some minor improvement. They might pay 8 to 10, and the leverage is pretty much low, the bank financing on these deals. So in other words, an investor could pretty much sleep at night. But where it starts to get a little bit more involved is what we call the value-added deals, which have a higher percentage of leverage. But there you're looking at returns, let's say 11 to 15%. And then you have ultimately the opportunistic funds, which you're looking for high leverage deals where you're looking for greater than 20% returns. So it all depends on the risk profile. So back to the question. So if you're going in and you're saying, I'm looking for cash distributions, my so-called dividend, I want it constant, I want to buy a deal that's stable. In the case of real estate, a multifamily property where rents are stable, occupancy is high there, it's in fairly good shape there, then that's a difference. So you give up, so to speak, that grand slam scenario, as opposed to taking it to like an opportunistic fund. Like I'm working with probably one of the biggest landowners, deal makers in the country, and we're looking opportunistically now, the recession, because we feel that land is a good inflation hedge. So that's an opportunistic deal because you're buying land on the proposition that perhaps you're buying it, you might develop it, you might sell it off, you might sell it to a home builder. Well, luckily, an Amazon comes, opens up this big warehouse across the street from you, and lo and behold, you have a home run scenario.
Yep. We're speaking with Harry Dublinsky, principal at Wilson Park Group, and Jay Cardwell, COO at the CFO Squad. Harry, how can people find out more information about your firm?
Wilson Park Group is my website. I'm open, looking forward to speaking to our great listeners here, loyal fans like myself of Yitzchok Saftlas.
Thank you.
Mind your business and bottom line marketing.
Thank you. And I turn to Jay. How can people find out more information about CFO Squad?
You can look us up on the internet at www.cfosquad.com.
Mind your business with Yitzchok Saftlas right here on 710 WOR, the voice of New York, and around the world on the iHeartRadio network. In case you tuned in late, where were you? We have two incredible guests, and we're talking about really the financial health of a company, due diligence. And in this segment, we're going to talk about, for those that are curious, and who isn't, about taking a company public. What's that all about? What are the benefits? We're going to get to that soon. My guests are none other than Harry Dublinsky, principal at Wilson Park Group, and Jay Cardwell, COO at the CFO Squad. I turned to, before the break and the previous segments of the show, we were talking about due diligence. So a quick question to Jay. What are some of the mistakes from your vantage point? And tonight you're representing the seller, okay? What are some of the mistakes that you would say a seller makes as opposed to not being prepared properly for due diligence?
Right. I think you just sort of said it, is not being ready.
Yeah. The answer was in the question.
There are some fairly standard, questions out there that everybody, an attorney can provide a list. We can provide a list. A lot of people provide a list, and you should go down them and have them ready. Don't walk into a room without having that. But the biggest mistake I saw, we got to closing. Everybody wanted to do the deal, wanted to close. The seller had not maintained their corporate status with the state of Delaware where they were formed, and they had been administratively dissolved because they hadn't kept their records, and therefore the corporation didn't exist and they couldn't close. Now, luckily,
on a small technicality.
Now they got it reinstated and they closed the next week. But guess what? Everybody was really, really nervous about what else do we not know.
Wow, what a story.
And it almost blew up. Yeah.
What a story. Harry, can you beat that story from the buyer side?
No, terrific. Look, it's a hard struggle because when a buyer is locks in onto an asset, a property, or a business there, it's very hard to deter them, especially when there's some type of relationship, with the seller's target. They might know the person, or they might know them in industry there, and they're buying into the vision, into the talk. But we're here to help walk the talk, so to speak, to determine at least the buyer has all the information in front of them, so they can make a proper risk assessment there. I have a sigh of relief, to be quite honest with you, on deals, so happy deals that my clients at the last minute decided we're not going ahead with. One was a digital kids show with animated characters and all that. Lo and behold, 2 months later, the sponsor visionary enters into a messy divorce. So the focus goes out there. So we're dealing with the tangibles, but you always got to leave room for the intangibles out there, because human capital, how strong is the bench? Does the sponsor, do they know the deal? And it's all dependent, like we said, there's so many different deals you're looking at the end of the day. I remember sitting in an investment committee with a noted New York City real estate billionaire, and he really held court with all his investment folks around him, looking at deals and talking about unit economics. If he didn't like replacement costs there, he nixed the deal within 2 minutes. Why? Because he established a very important discipline. I rather turn away most deals that come across my desk than get stuck in a deal that I'm going to have to live to regret. So that's the importance. That's what you find vis-a-vis best practices. Don't get carried away with the vision. Trust, but verify, and make sure the sponsor or the seller can walk their talk.
I'm so honored to be speaking with both of you. And just every week, we share so much wisdom on this program, and tonight is no different. I mean, anyone that is thinking about buying or selling or taking their company public, we're going to get to shortly. Tonight's show really shared a tremendous amount. Of course, it goes without saying that always contact your particular financial advisor for the advice that you particularly need. Of course, feel free to reach out to Harry Dublinsky at Wilson Park Group or Jay Cardwell at CFO Squad. A couple more questions as we approach the close of the show. Jay, perhaps you could just share another tip from the seller side before they even meet with a prospective buyer or investor.
Read up and find as much history or information that you can find on that buyer or that investor. Know why they're coming to you, know why they're interested, and maintain that connection, of their priorities and what they see in your company. But also make sure when you walk in that room that you're as transparent and as real to them as possible. They're going to find out about the warts. So, you don't have to bring them all to the surface when you walk into the room, but know what your warts are and think about how you believe that they're not as big as what the buyer might perceive them to be. So.
Now, we're recording this show in May 2022, and the reason why I say that is because people will be watching this on YouTube for years and listening on Spotify, etc. The market has been quite volatile in the last couple of weeks. Let's put that aside. What is the allure for a company, what is the allure for a company to go public? I turn to Jay.
I think one, it's access to capital markets. There's a lot of companies that may have had a great business in a localized area or in a certain sector, and they want to be able to expand and grow, and they need access to the market to grow with them as fast as the demand of their product or that their business might be. They may only be in the New York market, but now they want to expand to Chicago or Miami or Los Angeles, and they need access to capital.
So that sounds very rosy. What are some of the downsides? Why would a company not go public?
They're not big enough yet, or they're not prepared with the backing because it's expensive to go public. And if they're truly not ready, those expenses can dwarf their current earnings. And all they're doing is borrowing money and looking for money to stay public. So I always say, be big enough to be public.
It's a great line.
Just add
Yes, Harry.
Add to that. You have a captive audience. You have the SEC. Gary Gensler, the commissioner, is very hands-on, so to speak. And you just look at some of the recent cases. Musk bought Twitter. He's taking the company private. And you saw what happened with WeWork, where as a private company, they said they were worth over $40 billion. Once, they started moving towards the public arena, then that valuation went way down, I think, to 10 billion or below there. So you got to be prepared to basically work in that arena, be, subject to review by the SEC, to be analyst calls and all that. You blow a quarter, it has repercussions. You have to have that fortitude in order to play in that public arena.
And sometimes, if I can just interject, sometimes you're now running your own business, but now you're running the business of being a publicly traded company, And from our firm, we're there to help companies in their financial reporting, but you're on timetables. There is no such thing, to be in that marketplace of being late, with your filings, and try to sustain yourself as a public company. So,
just pretty much a common sense question. I'm going to turn to Harry and to Jay. How important is it to understand the day-to-day cash flow of a business when pursuing a deal?
I'd say if you're buying an operating business, like I mentioned a little earlier, and you're in the cockpit on day one, you want to basically have a very seamless, smooth transition, business as usual there. And there's tremendous transitional issues that you have. What's the company culture, and how do you step in and deal with if there's inner politics and all that without losing a beat there. So I think you definitely have to have a handle on the cash situation of the company, and that's why it's important as you're going through the diligence process to simulate, stress test what your working capital model is going to be. Test your receivables. The company looks nice and rosy, but you look at the aging of the receivables, you're realizing that cash isn't necessarily coming in the door there. So you got to be prepared. You have to have the reserves because you have a captive audience. Your customers are aware that, management has changed and they want to, some might be looking to take advantage, renegotiate deals and what have you. So you have to be really like an army prepares for battle. Similarly, you have to have all your ducks in a row.
And Jay?
Many times and frequently we're asked, our clients, are they a going concern? And it's all about cash flow. Is there enough cash on hand that can sustain the company for the next year? Are they making enough money? And what is that, what you'll hear, burn rate? How much money do you need every single month to pay the bills? And if you don't collect your revenues, do you have enough cash to do it? And there's a difference between what we say pre-revenue and post-revenue, but it's that going concern issue that will sometimes jump in and sort of create a shadow over a company. And it's all about the cash flow. Do you have enough cash?
Wow, that time flies here on the Mind Your Business show. We are out of time, but before I let Harry and Jay go, Harry Dublinsky, principal at Wilson Park Group, how can people find out more about your array of services?
Check our company out at thewilsonparkgroup.com. Feel free to reach out. Contact information is included, and happy to meet, happy to jump on a call. I guess a little happy to jump on a Zoom if it's still,
still a way to communicate. Yes. And I turn to Jay. How can people find more information about CFO Squad?
You can look us up at cfosquad.com, and you can reach out to us there. But we're in New York, but we have multiple offices, and we'd be glad to meet with anybody in person. But also, we frequently take calls from around the world, to deal with issues. And so, put your name in, and we'll give you a call back. So.
What an incredible show. We're out of time, but in case you tuned in late or you realize, hey, these guys shared so much wisdom, I got to go back and listen to this again. That makes sense. Well, by Tuesday morning, this will be up on the podcasting channel. Spotify happens to be quite popular. And of course, in a couple of weeks, this will be up on our very popular YouTube channel. On YouTube, we're at 710 WOR Mind Your Business. When you subscribe, you click on that button in the corner, the subscribe button. The benefit is you're notified every single time an episode goes live. Well, we're out of time. Tune in again next Sunday night for another great edition of Mind Your Business right here on 710 WOR. Have a successful week. Thank you for watching, and make sure to subscribe to this channel and be notified every single time a new video goes live. Don't miss out on any of the weekly interviews that I have with top business leaders, sometimes Fortune 500 executives. Hit subscribe and turn on notifications.